If you've ever wanted to write off your Range Rover, this is how you do it properly. So you've probably seen on the internet a bunch of videos about, hey, buy this Range Rover, buy this Bentley, buy this, Mercedes, whatever, and just get a huge deduction, and then you'll save a bunch of money on taxes and you have this sick car, and basically for free. That's basically what they're guaranteeing you. But it's more nuanced than that. So you want to make sure that you're doing this properly, and this video is really how you take the car deduction in the right way. So there's two ways you take the car deduction. Again, this also depends on what type of business entity you have. So if you have a sole proprietor and a single member LLC, from a tax perspective, those are the same. We talked about that in our home office video, how that's the same. You can watch that video in the link below. But we get this common question about, how do I get my car deduction? Because I've seen videos, whatever. So for single member LLC, sole proprietor, we're going to talk about how you do that first. Then we're going to talk about for an S-Corp as well, because that's a little different. But yeah, so to start, let's talk about the single member LLC and the sole proprietor. So how do you get the car deduction? How do I just bought this new car. I might have, used a loan to get it. I want to just take it all. How do I get the biggest deduction? I spent 50 grand on it. What do I do? So there's two ways. You either take the standard mileage rate or you take the actual expense method. The standard mileage rate at the time of this video, I believe it's 70 cents a mile that you can take. So every mile you drive that's business related, you would get a 70 cents deduction. So if you drive 10,000 miles in a year, that's a $7,000 deduction. The other way is you add up all of your expenses that you spent on your car. So gas, tire change, oil change, repairs, anything of that, plus the cost, and you can depreciate the car at times, and then you times that by the usage rate. In both scenarios, you need to track your miles. That is the number one thing you must do if you want to get the car deduction. Before you do anything else, you got to know your mileage you drove. Whether you're taking the actual expense method or you take the standard mileage rate, you got to know your miles. And we recommend, if you have QuickBooks, you work with us, the QuickBooks app tracks it for you, or you can do MileIQ, TripLog. There's a few other apps that do it. And it's pretty simple. You just go on there after a business trip, you swipe right or left, you say what the business trip was for. I went to go see a client. This is where it was. And then you just check the box, and it keeps track of it for you. So you got to keep track of your miles. It is tedious and it is annoying at times. Like, no one wants to do that, but you can do it like once every few days or every day or once a week. But you have to create a log. It's called a mileage log, because if you don't, then if you got audited, there would be no proof that you actually went there for business. If you're watching this video and like, oh, for the last tax year, I didn't keep a mileage log, but I want to get the mileage deduction, I want to run off my car, you can create a mileage log, and we can send you a sheet or a template for that for free. And in our video explanation how to do that, if you want, just let us know and we'll do that. But basically, you create a sheet, figure out, okay, I remember I went, here for, if I'm, a photographer, and I know I went to this location for a few shoots, like probably twice a month, and you're like, oh, that's 10 miles away. So you're just like, okay, you create in the log, okay, I went there, and then you do it like that. But you have to create something of substance. So yeah, that is the number one thing. Track your miles, track your miles. Can't emphasize that enough. So once you've done that, you've been tracking your miles, you're like, great. Okay, it's coming towards the end of the year. You're like, okay, what should I do? Should I take the standard rate? Do I take the actual expense method? Again, this is for sole proprietors, single member LLCs. Typically, if you're in a business like photographers, real estate agents, I don't know, people who go around and you're meeting clients, you're going to different things, events, venues, then the standard mileage rate is going to give you a bigger deduction because you've driven more miles, 70 cents a mile. So that's the case. But either way, at the end of the year, you can, if you're unsure, you can run both ways. You can have your person run both ways and be like, okay, I don't know which one's which. And then you just choose the one that's more. But one thing to note is if you do choose the actual expense method, you have to stick with that method every year. You can't change. So if you do the standard mileage rate one year, then you're like, next year, like, oh, I want to do the actual. Okay, then you could switch. But if you start with the actual, you can't switch. So the standard mileage rate is more simple. You don't have to keep track of anything except for your miles, like all your repairs, whatever. So that's another thing to note. But yeah, so you want to make sure that you keep track of your miles. And when it comes in the year, you can decide which one is which. Just know if you do decide the actual expense method that you can't switch moving forward. Another thing to note is that you need to spend on your car, if you're a single member LLC, sole proprietor, from the personal bank account. Do not use your business bank account to pay for gas, to pay for repairs, to pay for anything related to your car, because that is a personal expense. The vehicle is not titled in the business name. If it is, that's a separate subject, and we'll get to that. But the vehicle is titled in your personal name. So you need to make sure that you are spending from the personal side, and then you get the deduction at the end of the year. So we do not want to see, if we're doing your books, oh, gas expenses, Shell, Exxon, whatever you're spending stuff on. We don't want to see that. That's on your personal side. So make sure that you spend from your personal side on the vehicle like that. And so at the end of the year, you would total your gas, repairs, stuff like that. So now we're going to get to the actual writing off of the car. So people are like, oh, I can write off this car. So let's say you buy a $50,000 car and you're like, I want to depreciate all of that, take the expense all in 1 year. You're a single member LLC or a sole proprietor. You buy a $50,000 car in your own name and you want to try and take it all. You need to know how much business use percentage you have. So let's say you've tracked your miles on it, and at the end of the year, you're like, okay, I've got 70% business use. Okay, great. It needs to be above 50%. Now, depending on the weight, it can change things a little bit. But if it's above the 50% mark, then you can either do a bonus depreciation, which is, it's going to be capped at 60% of the value in 1 year, or you can do Section 179 if it qualifies. And that means you can expense it all in 1 year and take that depreciation. Now, again, you don't always necessarily want to take the whole write-off of the car. Like, if you've got like a lot of other income in the business, and you're like, I just need to get losses and I need to, get stuff going. Okay, but for a lot of single member or sole proprietors, that's not always the case. So it's better to spread out that expense over the years, because if you take $50,000 1 year, you're not getting that in the next year. So then you don't get that expense in the next year. So you want to make sure that if you are going to take it all in 1 year, you take it like that, or you have good reason to do it. But regardless, you have to track your miles. And again, if you do depreciate it, you're only depreciating 70% of the value because that's your business use. You're not depreciating so it'd be 70% times $50,000, which in this scenario, I believe is $35,000. So that would be your deduction for that, because that was your business use percentage. So that's another thing though. If you do use a loan, you can still depreciate it. So that's cool. But then you still have the loan to pay. But yeah, if you lease a car, you don't own it, so you can't depreciate it. You can deduct the business use percentage of that lease. So it would be, if you choose the actual expense method. So let's say you pay $1,000 a month for a car and you have 70% business use, then it'll be $700 a month. Or that would be your deduction. And that's the actual expense method. The standard method is 70 cents a mile. More simple. You're not depreciating the car. You're not taking it all in 1 year, because it factors in on that 70 cents. The IRS is factoring in depreciation and stuff. So they're factoring in all that. So it's already factored in. So that's why you take it. For many of our clients, the standard mileage rate makes more sense. You get more of a deduction and it's simpler. But for those, we do have some clients who have like a full fleet of vehicles and they're like buying new vehicles every year. And they're like, okay, this one I'm going to depreciate. This one, we're not going to depreciate all in 1 year, and we're going to stretch it out. So yeah. Hopefully that gives some idea for single member LLCs and sole proprietors how you take the vehicle deduction. It's either standard mileage rate or actual expense method. You have to keep track of your miles for both ways. We got to know your business use percentage. That's what the mileage does. And then you can decide, okay, which one's more beneficial for me in your situation. So hopefully that clears that up. Now, if you are an S-Corp owner, how you get the mileage deduction is different. Again, if you own the vehicle in your own name, or if you own it in the business name, that is separate as well. We recommend to own it in your own name. Owning it in the business name, oftentimes insurance is not as good. It opens up to more liability. That's more of an attorney question, but it's not what we would recommend. Unless it is 100% for business and yeah, you've got another personal car. So if you're an S-Corp owner and you own it in your own name, then you would get reimbursed for your mileage rate. And this comes back to the accountable plan. So recommend watching that video, because you get reimbursed for your mileage in this case. So after every 3 months or a month, if you're doing it that way, you'd be like, okay, I drove this amount of miles, 70 cents a mile. Okay, so let's say after 3 months, you drive 3,000, or let's say 1,000 miles after 3 months. And you would then take that business usage rate. So if you're doing the actual expense method, so let's say you figured out, oh, okay, I drove a total of 2,000 miles and I drove 1,000 for business. That's 50%. So 50% would be your deduction against all your gas, repairs, maintenance. That's the actual expense method under the accountable plan for an S-Corp, and it's in your own name. We don't always recommend that one because you can also get depreciation reimbursed that way as well. But usually the standard mileage rate is better. So 70 cents a mile, you own the car in your own name, you're an S-Corp owner, and you want to get reimbursed for the mileage you drove. So you just put in the mileage you drove for business into the accountable plan sheet that you saw in the other video, the accountable plan video. And then you times that by 70%. So if I drove 1,000 miles over 3 months times 70%, $700, you transfer $700 from the business account to your personal account, and it's marked as an accountable plan reimbursement on the profit and loss. So that is how you would do it as an S-Corp owner. You get reimbursed for that money. If you own the vehicle title in the business name and it's 100% business use, then you can use the business card for gas, repairs, stuff like that, anything related to that vehicle, you can do that. If it's in your personal name, you need to be spending it all on personal, and you need to track miles for both, unless it's 100% business use and you're like, I know this is all business use, then okay. But more times than not, you're in the other scenario where it's in your personal name. So hope that clears some things up so that you know now, okay, how do I deduct a business vehicle for business? Can I just go buy a Range Rover? You can go buy a Range Rover, but what is the business use of it? Percentage of it? How many miles did you drive on it? Does it even make sense to depreciate it all in 1 year? How much is that deduction? Does it even qualify for the depreciation? So those are things you need to ask. But if you don't learn anything out of this video, I hope that you learn, keep track of your miles, whether that's the personal, you own it in your personal name, and you're doing the standard mileage rate, or you're doing the actual expense method. So yeah, hopefully that helps. And let me know if you have any questions. Let me know in the comments what type of vehicle you drive, and we will see you in the next video.